Perfect. See a couple more people coming in. Good morning, you guys. Happy Monday. I hope you guys had a great weekend. And I know last week was Veterans Day, so a lot of you guys were off. I was in the office working, but decided that we would do the Monday Mortgage Minute on a business day. But Good morning. We want to talk. We're going to kind of really just more so talk about mortgage rates. I think more than we typically do on here. We'll go over some data points now, but I think it's kind of important to know where we're at, especially with the assumption that we thought as the um, new regime would come, whether that at the time was Trump or Kamala, just a stabilization for the next 4 years. And then, of course, with the Fed cutting rates, that we would see mortgage rates themselves just kind of stabilize and get to a point where they would, if not trend up or down, but tread steadily. And it seems like it hasn't happened, at least for the first part of this month. And I think a big part of it is the inflation reports that we've gotten. So CPI showed inflation increased 0.2% in October, with the annual reading increasing to 2.6% from 2.4%. Core CPI held steady at 3.3% year over year. Core basically strips out food and energy, because those are the two things that are volatile month to month. It does seem, though, that since the Fed has started cutting rates, that inflation has started to spike again. So within the data, if we're just looking at the CPI number, it looks like it hasn't really increased much, especially with core CPI. But looking at the last 3 months, which is when the Fed started to cut rates, we're seeing that if we were to annualize that number, inflation would be at 3.5% year over year. So because of that, there's a lot of talks of the Fed possibly not cutting rates in December. That's probably a big reason as to why they're monitoring when they started to cut rates, how inflation has played a part since then, and we do see a significant difference in the opposite direction with inflation in the last 3 months. So most likely they will not be cutting rates in December. However, I'm not part of the Federal Reserve, so we can't guarantee that. But just kind of looking at the data points and looking at the market and the people that do have the assumption is that they're not going to in December, which I think is okay, because we've spoken about it, right? The Fed doesn't necessarily, or the Fed rate doesn't necessarily reflect mortgage rates one for one. The reason why they've been so closely related the past couple of years is because of inflation, which hurts everything, including mortgage rates. But we'll talk about that a little bit lower. Purchase applications are up by 1% year over year, but inventory is also rising, and it's much higher than this time last year. So inventory this time last year was at 569,898, while this year we're currently at 722,000 homes for sale nationally, of course. Now, this isn't because people aren't buying either, because the current pending sales are at 333,177, where last year they were around 270,000. So we're seeing about what is that, 60, yeah, about 63,000 more homes for pending contract right now than last year, and about 140,000 more homes for sale as well. So the market is picking up on the listing side, and it's pretty much staying steady on the buying side as well. But since we're starting to see more homes being put on the market now than last year, right, you start to ask how come, right? What's going on here with sellers? What kind of, I guess, predicaments are they in, if there's any predicaments that they actually are in right now or not? We've spoken about sellers wanting to hold off and keeping onto their homes until rates start to come down. But with more listings, that makes you think, is there an issue with the usual homeowner, the homeowners now? Are they, in a bad spot, going through some sort of hard times? Do they believe a crash is coming and they're just trying to list now before their home prices have topped out and are ready to hit a bottom? Or are they just tired of waiting, right? Do they believe that they can't lean into 2025 without purchasing their new home for whatever reason? Debt could also be a factor for a lot of people, which I think is the number one thing that we're seeing in general, when we're talking about revolving credit and even installment credit with high APRs across the board, maybe just, wanting to sell your home to pay off all your debt and start over fresh is another option that people will probably be looking at. But as we kind of look at the first option, are people in trouble? Because that's what's most important to us in the industry. Foreclosures are down year over year from last year at 11%. So I don't see that being a reason for increased inventory right now. So it could be one of the other options that we gave, and they're down from last year 11%. By the way, the foreclosures are not at 11%. That would be a ridiculous number, but they're down last year on an average of 11%. I think the total filings for last month was 34,000, and Florida was one of the higher ones. I think at like 3,000 as part of the higher states that pretty much foreclosed on homes and even initiated those foreclosure filings. But we're nowhere near where we were pre-pandemic, let alone last year when people thought that foreclosures were going to increase. And last year's numbers were relatively high, but not higher than pre-pandemic at the same time as well. So some quick data points. National inventory, like I mentioned, is at 722,000. The median list price right now nationally is 430,000. The average days on market is 104. Price reductions, 2,227. Thanks. Average days on market is 104 days. Price reductions, we're seeing 39% of listings have them. The average rate right now is at 7.05 as of this morning. It could increase later on today as we kind of look at mortgage-backed securities and the 10-year Treasury. The 10-year Treasury is at 4.45% right now. So there is some good news when it comes to rates, and that's that spread between the 10-year and mortgage rates. So for those of you who don't know, this is the actual direct correlation that a lot of people believe that the Fed rate is to mortgage rates, but really is not. It's the 10-year Treasury. Wherever you see the 10-year Treasury at, you typically know or can tell where mortgage rates are at for that day specifically. So the 10-year Treasury shows you typically where rates are, and historically has been lower by 2% than the mortgage rate for that day. So in a normal market pre-pandemic, if the 10-year Treasury was at 4%, that means, or return of 4, that means that mortgage rates were at 6%, give or take. And that's really how you can tell where mortgage rates are on any given day and what that average would look like I mentioned, in a normal market. And I say that because since post-pandemic, that hasn't happened. But the reason why those two are so directly correlated is because as an investor, when you're looking to invest long-term, your two safest bets are with the US, because the US always pays back their debts, right? Which is that 10-year long-term, or 30-year mortgage rates, which we know historically have been one of the safest bets, except for one time in history, which was 07 and 08. So those are the two that you're looking at. And 30-year, because it's longer than the 10-year, right? You're going to see a little bit more premium or return on investment when you go that route. So that's why that difference of that 2% has been there historically. It's just that long-term investment. But post-pandemic, 2020, when they started about 2022-ish, when the Fed started to raise the Fed funds rate, inflation hit an all-time high. They were getting things off their balance sheet, so on and so forth. You would see that spread at about close to 3% or 300 basis points. So if the U.S. Treasury was at 4 flat as opposed to 4.45, rates would have been at 7 at the time. 4.5, rates at 7.5, 8%. And that's where you saw that big fluctuation over time. And to be from 3% to now about 2.5 roughly is what we're seeing, at least for today, with the 10-year Treasury at 4.5% roughly, and the average rate at 7%. That means that spread is starting to come down, which is what we believed would happen as we got further away from post-pandemic. So all we need realistically is for the 10-year to start to come down, and we'll see mortgage rates reflect much more positively in the future as well. But just to kind of give you an example, as early as this year, in April of this year, or no, May and April both, we saw the 10-year Treasury hit the same number that it's hit now, that 4.5%. And rates at both of those times in April was at 7.3%, 7.34% on average. And in May was at 7.25% on average. So you saw that 2.75 to 2.8 discrepancy between the 10-year and mortgage rates. So that's the good news. We're starting to see that spread lower. However, what we need is for mortgage rates to come down in general, especially with dealing with the Florida market specifically, right? Because we're talking about property taxes have increased drastically here. And that's because we don't have state taxes, right? So there's a good give and take when you're looking at no state taxes as opposed to other states that do. Your property taxes aren't going to increase that much, but you don't see that much more on your paycheck and vice versa, right? But property taxes skyrocketing over here, as well as our homeowners insurance costs as well. So those two things with high rates and high high affordability causes a big issue for clients that are looking to purchase and they're trying to, but they're being pushed down lower and lower in price point. And I think as the inventory continues to increase and we do see more buyers market, that 39% price reduction is going to increase to maybe, 40, 45%, where you're seeing a lot of people just kind of coming down on the price points on the homes or giving a bunch of credits in order to make the deals work. Because as a seller, once you made that commitment to list it on the market, you pretty much already have plans to leave that property. It's very rare that you're listing just to list. A lot of times there's a purpose for it, and you've already kind of made up your mind to even have it on the property in general, or to even have it on the market in general. And I think we're going to continue to see more price reductions if rates stay elevated, at least in the South Florida market, because of everything else that kind of comes with it, right? The property taxes, the homeowners insurance increases that we're seeing. I had priced out a property yesterday, closing cost worksheet, and the property taxes are $11,000 a year on that property. That listing price was $450. So you're talking about more than 2% more than what the purchase price is in property taxes. Obviously, it's not homesteaded, right? There's benefits to being able to purchase a primary residence, but to see that difference, even as an investor, when you're talking about the difference in property taxes compared to what that property is actually quote unquote worth is a drastic difference. Somebody asked what city was that? I'll tell you right now. Lauderhill. Lauderhill. Yeah, $11,436. Ridiculous amount. That's almost $1,000 a month in just property taxes in and of itself. So you're seeing that, and then you get insurance quotes $5,500, $6,000 a year. Do the math, divide that by 12, that's $500 a month in homeowners insurance. So when you're looking at your escrows in general, there isn't much more room for you to go purchase price wise, especially with rates being higher. So hopefully, as we kind of lean into the new year, those treasuries do start to come down, mortgage rates start to come down, but we look at what we can control. And I've been telling you guys this for a while. Make sure that you are doing your business planning for 2025 and pivot over to listings, right? Even though it looks like it could be a buyer's market in a few months, buyers are much easier to come across. And buyers are going to be, that buyer's market is going to be very temporary, especially if rates start to come down. You'll see houses start to flip very, very quickly. And those average days on market will come down as well. So focus on the seller side as much as you can. Buyers are always going to be there. They're going to be coming into the market, especially since we know that they're just waiting for the right time. A lot of them are. Before we go, I went to Atlanta this weekend where NAREB had released their SHIBA report, the State of Housing in Black America report. And there's a lot of data in there. I'm going to try to put together some bullet points for you guys of the more important things that I kind of come across on there. It is 77 pages long. So we'll probably try to do that next week, but I am giving you guys the link for it if you want to read it. Very, very daunting in terms of the homeownership gap in general. And what you're seeing when you look at the data points between Black Americans, Hispanics, and non-Hispanic whites as well, and what that separation looks like from the Black and brown community to just the to the white community. So if you guys want to read it, it's there. It is very long. It's a bit saddening as well. There wasn't much good news that kind of came from that report, if any at all, besides the fact that we're seeing more conventional loans as opposed to unconventional loans for Black and brown communities as opposed to before. But the home ownership gap is widening much more than it was pre-fair housing. And you're seeing more wealth being built in white communities as opposed to Black communities because of appraisal bias. HUD did charge an appraiser recently. I think it was a couple of weeks ago. It was on Housing Wire, and the Secretary of HUD confirmed it at the conference. They did charge an appraiser for appraisal bias through Rocket Mortgage, I think was the lender at the time. And that appraiser no longer has a job. So it looks like they are doing what they can to minimize that. But it's a good read. Like I mentioned, it's a bit saddening, unfortunately. And the data points that are not on here that I'm very interested in seeing is average credit scores as well, just to really see where that data lies compared to approvals, denials, withdrawals, so on and so forth, within these communities compared to what the average credit scores are within them as well. All right. That's the only thing this data doesn't show, and that is because James Carr, which is the author for this, did mention that that data is not out just yet, and he's waiting for it. But the HMDA information for average credit scores could tell a much scarier story if we see that the average credit scores really don't differentiate that much. You guys have any questions, any scenarios that you came across this past week that you want to talk about or go over? Yeah, Kia.
Hey Mike, good
Hey,
morning.
good
Good morning.
morning.
I have a question. So I had an open house over the weekend, and I did receive two offers, one of which is a full price, all cash offer. And in this market, I'm just asking really for what are some best practices as far as vetting that offer and the cash that they claim to have.
Asking for proof of funds, really. Let me see that you actually have the funds in your account, and that you have the money. And most of the time, the buyer's agents will give you that information. You don't need the full bank statement. You don't need the account number, but let me see your name and the funds in there that show that that's your money, pretty much.
Okay. And should it just be like 1 month, 3 months, 6 months? Like,
Yeah, it's if it's cash, it's you only need the current month. It doesn't matter if they have a large deposit of some sort or whatever, as long as they have the funds in there and they're going to be able to close on that property. Um, with the cash, you should be fine.
okay. And then my other question is, should I be leery of them wanting a 30-day closing, even though it's cash?
Maybe not wary, but yeah, I mean, it does raise a question, right? Why do you need so long to close? Are you relocating? Like, what's the purpose of the 30-day when if you have the cash ready, title's probably going to take about 2 weeks. We can wrap this up much quicker. So
Right.
definitely asking that question to them so that they can, see what answer they give you.
Okay. I appreciate that. Thank you.
No problem. No problem, Kia. Any other questions? No, that's actually a data point there within the Shiba report too. Investors, the amount that they're purchasing and where they're purchasing at, what kind of communities and stuff like that. They are maybe trying to wholesale your property. Yeah, that's also Kenneth has a good point. So just on that contract, the way you'll know very quickly is if it's assignable or not. You don't even have to ask them. You look, if it's assignable, then they're probably trying to wholesale it.
Thanks, guys. And thanks for the congratulations in the chat. Really appreciate it.
Yeah, 14 days tops is what cash needs. Yeah. Thank you guys. Thank you guys for the feedback with Kia. Congrats, Kia. Hopefully that one closes smoothly for sure. Um, is a 7% national average or current average in Florida? So Gina asked about the rates. 7% is national average. Um, everybody's going to be this around the same when it comes to mortgage rates because we have to sell them all to the same people, right? The GSEs, Wall Street. So the national average is going to be what the local average is, unless there's a lender trying to make more per deal than another, which usually happens with banks, which is why their banks are much more competitive because they're willing to make less per mortgage that they do. Um, because they don't really just focus on mortgages. They have other things that they're doing as well besides that. But yeah, the 7% is going to be average nationwide. Which reminds me as well, DPAs, Florida Housing, which typically has the lower rates, is up as well, 7% on the Florida bond. I think 7.25 on the TBA, and that's just on FHA. On conventional, I think it's 7.5 for the Florida bond and 7.875 or 7.625 on the conventional TBA. So you're seeing even with the DPAs that are typically below market, those rates have increased as well on the DPA side. All right, everyone. Hope you have a good one. Any questions, anything you guys need, don't hesitate to reach out to us, okay?